Welcome back to the channel, guys. I just wanted to cover off a new video around the IncomeShares change in strategy. I know a lot of people have been asking me about the laddered puts and how they might work and how the new strategy might work. So I thought I would cover off a bit of a user case. The MicroStrategy is one of the funds where they're obviously changing the strategy. We have heard from IncomeShares that the new strategy will apply to the older funds, so Nvidia, Tesla, Coinbase, etc. So they will be on the 25th of July move to the new strategy as well. So what is the new strategy? The new strategy is they're going to take the cash that comes into the fund. They're going to sell put options, and in this case, MSTR. They might have various strikes. Now, the reason why they might have various strikes is that as soon as the cash comes into the fund now, they're not going to wait till the following week to use that cash. They're going to deploy that. So it could be that they get the cash in on a Tuesday and Wednesday, and therefore they need to have a different strike price due to the time element of when they open the position. And we'll talk about the time element a little bit later on. They then collect the premiums, which they then issue out to us. Now, there is the intrinsic and the extrinsic, which we'll talk about later on, but they are only issuing the extrinsic part of the option. And I'll talk a little bit why that's important as well in terms of the put strategy as well. The other part of it is they're going to hold the underlyings. They're actually going to hold MSTR stock. And this is quite important because they're going to hold 25% of it so that they can capture as much of the upside. So if it goes on a bull run, they can capture all of that. They are also going to manage that 25% actively along with the put options themselves, the strike prices for the put options themselves. And again, we'll dig into that a little bit later on in the video. So let's start to really get into the meat of the video now. Again, there's a lot of detail to go through here, and I'm going to try and keep the pace deliberately a little bit slower just so it's easier to follow. I've tried to use my usual infographics to help explain things as best I can to you guys. I've kept it in dark mode. I've created the sections, whichever one preferred. Again, let me know in the comments whether you prefer the dark mode still and the sectioning. Okay, so how does the NAV grow with the laddered put writing strategy? So imagine if we had MSTR, okay? You could have different strike prices when it comes to puts, a bit like what you can do with covered calls. And there are three scenarios. There is out of the money put, an at the money put, and an in the money put. The out of the money put only has extrinsic value. So that's the $5 in this particular user case example. You can have an at the money put, which again only has extrinsic value. And remember, they're only distributing the extrinsic value to us. The final one is in the money put, and that has an element of intrinsic and extrinsic value. And we'll look at why, again, they might be doing in the money put over the other two in terms of out the money put and at the money put. Obviously, the other thing to bear in mind is the extrinsic value is the time value. So this is the portion of the options price that is not tied to its direct exercise value. So it basically represents the market's bet on volatility and the chances that option will become more valuable before expiring. For an option seller on the wire MST, this value naturally decays over time, and this is a concept known as Theta. And I've done a separate video, guys, on the Greek, so I'd recommend you go and watch that video separately just to give you some more context. But this decay works in the fund's favor because the eroding the options value and making it cheaper to close or more likely expire, in their case, worthless, which is the ideal scenario that they want. So what you'll see here is that when you open the position, it starts off with, and this is just an example, obviously $20, 60 days from expiry. But as we get closer to expiration, that time decay is exponential. And when we get to the expiry date, it's worthless because ultimately as time goes on more about the movement of a stock, the more time we're away from it, the less we know about the potential things that could happen. If we now look at the more detailed version of NAV movements themselves with a laddered strategy. So let's theoretically assume MSTR is trading at $100. and the ETP sells a ladder of 2 puts. We sell an out of the money put. And remember I said out of the money only has the extrinsic value. It has no intrinsic value. And then we also sell an in the money put, which does have an extrinsic and an intrinsic element. And in this particular example, we've set a strike price of $95 for the out of the money. The premium is $3 of extrinsic. When we sell our in the money put, we get a strike of 105 and we get a premium of $8. So we've got $5 of intrinsic and $3 of extrinsic. So if we look at this, let's assume at expiry, the MSTR price is 102. What this means is the total liability across the 2 trades have gone from $11 to $3. So we take that profit of the $8 coming from the 2 sources, the full $6 of extrinsic, okay, so that's the 3 on either side, and then the 2 gained as the intrinsic, and it fell from $5 to $3. So in the particular example of IncomeShares, they're not going to give us that $2 of extrinsic value. They're going to keep that, but they are going to issue the $6 of extrinsic value. So you can probably already see that those $2 are going to stay within the NAV. All right. And we're going to go into a bit more of a deep dive now, looking at that part of it. So here I've just got distributions versus the NAV, and I just want to talk about when stuff comes out of the fund. And there are basically 3 different scenarios when we talk about distributions. Let's assume in all these scenarios, we're starting off with $100, and we're going to start off with option A, which is retain all the profit. So imagine we start off with a NAV of 100, we then get $2 of intrinsic, $6 of extrinsic, we distribute nothing, the NAV will go up to 108 because we've earned the intrinsic and the extrinsic. Now that's not what IncomeShares does. Option B is where we start off with $100, we make the same $2 of intrinsic, we make the $6 of extrinsic, they then distribute those $6 of extrinsic, but the fund has grown by $102. So this is the example of what IncomeShares is actually doing. They're giving us all of that extrinsic value. And then obviously the hybrid option, which they could choose to do, is we start off with $100, they get $2 of extrinsic again, they get $6 of extrinsic again, but they only pay us $4. So they've kept back $2 of that intrinsic plus another $2 of that extrinsic. And so that's why we've gone up to 104. So we can see that actually when they're distributing this capital to us, guys, it's a transfer of capital that's happening here. They're not overpaying because they're not paying what they haven't earned, but it's coming out of the NAV and it's a transfer of capital to us. So our total net position in all these 3 scenarios is the same. It's 108 technically. It's just how that 108 is being transferred. It's either staying completely within the fund, it's either being given partially out to us in terms of a distribution. So just to point out, the only time where it's true return of capital is when they are giving out more than they've earned in the intrinsic and the extrinsic. That's when the NAV will continually decay. Now, there's this added slight step here now with this 25% growth allocation. So what IncomeShares are doing with the new strategy is to preserve more of the kind of increase in the bullishness of a stock, is they want to capture more of the upside of the stock itself. And the way in which they're doing that is they're keeping 25% of the underlying, in this case, MSTR directly, with the last 75% being used for the collateral for the put right income strategy, which will be held in cash. All right. So 75 becomes part of the income engine and 25% becomes the growth engine. I just want to explain the different scenarios that again can happen with these types of, and again, these are all theoretical examples, but it just hopefully conceptually helps you understand. So what we've got to realize here is that when we look at this, in a strong market, it's up 20%, the underlying. In the 70-25, we expect 7% return. With the pure income strategy, we would expect 2% return. In the sideways market, we would expect no return in our underlying, presume it went nowhere. We would still get 2% of our pure income from our pure income perspective. We would also only get 2% in the 75-25, because if you think about it, the 75 is giving you the 2% income as before, but the 25 isn't giving you any extra growth. Now, some may argue the income may give you a little bit more, possibly. Difficult to say. Now, in the down market, 15% down, the underlying drops. Yes, we get the premium that offsets it, but because we're not doing 100% now on the full account in the hybrid, we are going to still go down by 8.75%, but we're not going to take the full 15% because we're getting some of the premium offset. With the pure income strategy, because we are getting all of the income from all of it, we are going to take less of a total hit, total return. So we'll still be down, but it'll be down much less. So hopefully that gives you a flavor of the different scenarios. So we can see in a strong upward market, we would do substantially better by about 5%. In a sideways market, there wouldn't be much change. In a downward market, we would still go down, but the gap is a little bit better than the upward trend. So again, this is just worth mentioning that there's still going to be trade-offs here when we go down. A lot of the time people are bullish when they're buying these ETPs, these single stock ETPs, and so they're giving you that opportunity to take advantage of that extra growth with that 25%. So hopefully that gives you some flavor of the strategy and kind of what they're doing and what the outcomes could be. In terms of the risks and rewards, so let's cover the risks and rewards. So reward is, you've obviously got that high income potential as always. You can generate that significant monthly distributions from the options premiums. You've now got some more upside participation. So if it's on a real strong market rally, you're going to, with the 25% within that allocation is going to benefit from that. You've still got the downward protection with the premiums, just not as much as you would if it was just a pure income play. Capital efficiencies, you've obviously got cash, so that's a little bit easier to deploy. With 75%, they can redeploy that fairly quickly and they get interest on that cash as well, which they distribute. The risks, the concentration of the single stock risk still remains, unfortunately, so that's not going to change. You've got the downside still of the falling market. You've got still the dependency on the Vega, which is often referred to as the volatility risk of the implied volatility on the stock itself. And then there is some element of capital erosion, right, when these distributions are paid out. And if that exceeds the profits, and I'm going to use that word very carefully, if it exceeds the profits, then you're going to get true NAV decline over time. So in summary and conclusion, guys, this is obviously a defensible income tool for sophisticated, high-risk investment. So people need to have a bullish view on the stock. It is volatile. You need to bear in mind in terms of what you're buying. And the focus is still the same. It's the total return, so the NAV change plus the distribution. That is still the end goal here is, are they going to be able to give you good total returns over a long period of time? So there you go, guys. Hopefully that kind of helps you understand the put strategy a little bit better, how they can still grow the NAV even with a put, how the laddered put is so important, why doing in the money puts are more important because you get that intrinsic and extrinsic value portion. Let me know in the comments whether this helped guide your decision making a little bit, and whether this was useful, whether you still like the dark theme and you still like the tab layout. Again, let me know in the comments. Thanks a lot, guys. I will catch you on the next one.